Well, good. Well, good morning again, everybody. Hope you're enjoying the fall, this lovely, 60 plus degree weather that we're having in late October. Not too bad. Appreciate you taking some time to be with us again this morning for our monthly webinar programs. Max Ripperger is with me as always. And today we're actually going to talk about a topic that, if I had to guess, most of you have probably not heard the phrase, but for most all of you, we're probably already doing this to a very large degree. But I think it was a worthwhile topic to go over and just kind of walk through. Sometimes just to give you a little bit of a reminder of what we're doing and why we're doing it. So the topic is advanced time segmentation. And this is a strategy really that's been created over the last, I would say, 10 plus years or so. I think it's really only kind of had this name the last few years. Frankly, we've kind of talked about it in terms of buckets, if you will, but this is formalized it a little bit more. We've actually have purchased a software program that allows us to illustrate the use of this concept a little bit better. That for some of you that may make some sense for us to look at doing as well. So really today we're just going to introduce the topic, go through the benefits of the alternative investments and annuities. And one of the things we'll talk a little bit about here is why we use certain investments and why even in retirement it makes sense to use some investments that are considered to be maybe a little bit more aggressive, maybe have a little bit higher level of risk, maybe even have some illiquidity components to them. So we'll talk about the concept of that and why that is applicable. And then optimizing the portfolio for desired results. So even if we are already in retirement, doesn't necessarily mean that we don't need to massage, manipulate the portfolio, add in some investments, maybe even change some investments from time to time. That can happen for a couple of reasons. The first one can simply be because of the market dictates those changes. It could be because the economic environment, interest rates are different that would necessitate some changes. It also could be because of your particular situation. Maybe your income needs have increased, and therefore we've got to find ways to generate more income. And lastly, it could also happen because of the evolution of the financial products that are out there. And every time we go through different periods of time in the market, the financial products industry, if you will, tends to come out with different types of investments to help navigate the period of time we were just in. So, for example, if we go through very high interest rates very high inflation like we've just gone through, you'll find some products that are created to help hedge against inflation without taking a lot of risk. With extreme volatility in the market that we seem to be experiencing more often, there are now some investments out there called buffered investments that will help you predetermine the amount of risk that you want to take while still participating in the upside components of the market. So sometimes we make adjustments to your portfolio, even though we're well into retirement, simply because there are some better products available for us to use at that time. All right, so let's go ahead and kind of jump into this. So what is advanced time segmentation? It's a strategy aligning different assets to different time horizons. So we have various times that we are looking to establish for our investment portfolio. So just because we are in retirement or nearing retirement, that does not mean that we immediately have to have 100% of our money available to us. In fact, it's a question I get on a regular basis, more times from new people that are coming in, referrals of yours that are coming in to see us. They'll question whether or not they need to get entirely out of the market or need to reduce all of their risk because they're now at retirement. And that is not at all the case. We enter that phase of life called retirement, but we still God willing, we have 15, 20, 25 years, 30 years during retirement that we're going to live. We're going to need income. And so it's that retirement time period is that 2 or 3 decades. That's our timeline that we're looking at. So we don't just get to retirement and now all of a sudden put everything in CDs and cash. It just doesn't work that way. So these are our different time horizons. So we've got our short term, which is going to be our conservative investments like cash, money markets, things of that nature, all the way up to our long term growth investments for later years. Why are we concerned about growth in the later years? The number one reason, without question, is inflation. We want to be able to keep pace with inflation. And in order to do that, in order to give ourselves pay increases down the road, we have to have components of our portfolio working harder for us where we're not taking the income so that we have more available later on. Okay, Max, go ahead. All right, so why do we want to use the time segmentation concept? First of all, it helps provide predictable cash flow from conservative investments, can allow for long-term growth while managing volatility, and can help reduce the need to sell assets during downturns. So let's talk about these a little bit one at a time. Provide predictable cash flow of conservative investments. So for example, we may say, if we determine that we have a need for an extra $3,000 per month, right? So we've got Social Security coming in, maybe we have two Social Securities coming in, we've got a pension coming in, and we have a need over and above that for $3,000 per month, $36,000 per year that's going to come from our investment portfolio. Well, we know that that's what our need is. So how do we go about solving for that? There's a couple of different ways. We can set some money aside in our cash, in our money market, in our savings so that we know it's there. So for example, if we wanted to set aside 2 years of cash there, that would be $72,000. We know that we would have that money there without risk, no questions asked, no market volatility, right? That's very predictable. We can also blend that such that maybe we have part of it in money market or cash. Maybe we have other parts of our investments that are generating dividends or income that will supplement our income needs. So for example, change that scenario. We still need $3,000 a month, but now we have some investments that are kicking off dividends or income of $1,000 per month. So we know we've got 1,000 out of the 3,000 coming from that. Now we set aside $2,000 per month, $24,000 a year, $48,000 over the 2 years into our cash so that we have that available to us. So that's what we want to do for that short-term period of time, if you will. This could allow for long-term growth. The time segmentation allows for long-term growth while managing volatility. So if we separate out what our longer-term needs are, and by longer term, we're really talking about 6 to 7 years or longer, we can allow ourselves to have investments with risk, with market volatility, because we know historically since the inception of the market that while it can be very volatile in the short term, it becomes far more predictable and consistent as we start to lengthen out that time frame. And then lastly, why use time segmentation? Because it can help reduce the need to sell assets during downturns. So if we have everything still exposed to the market, so just the opposite of putting everything in cash, if we have everything still at risk in the market and the market all of a sudden takes a turn and we are now down for a particular year or period of time, and we need money, now we are having to sell at a discounted price. The problem with selling at a discounted price, other than the obvious, is that it now exacerbates that loss because now we have a smaller amount of money growing for us for the next year when we need more money. So that becomes problematic and something that we want to avoid if at all possible. All right, so let's go through what these buckets, these time periods are. Like we said, the short-term cash or CDs, it's 1 to 3 years. We're not interested or very concerned about the rate of return or the yield. We're more concerned about the liquid nature of this investment. We're more concerned about the stability of this investment such that we don't have to worry about market volatility. And again, the 1 to 3 years is not of all of your living expenses, it's of what needs to supplement the income that you've got coming in. So again, the example I had been using is the $3,000 per month. We first have to identify what is your need per month, okay? Then secondly is our midterm period of time. And this is our 3 to 10 year period. And again, can be coupled with a multitude of investments, quite frankly. It could be bonds, dividend paying stocks. There could even be some annuities in here that have some income riders that have a combination of growth and income. For some of you, I know that we've used the income annuity such that we're not taking income immediately from this, but we know in that 4, 5, 6 year time frame, we're going to turn that income on because that will be when our short-term money begins to run out. And now we start to supplement that with our midterm money. So we want to think about each different bucket is ultimately there to replace the bucket before it when it runs out of money or if it runs out of money. And then the long-term bucket is our stocks, real estate, and or alternatives, which is 10 plus years. Now, again, the reason we can take the risk, the reason that it's okay to have some investments that are illiquid, like alternative investments, it tends to be one of the issues with an alternative investment is that we can't necessarily get to our money right away. But because we have already predetermined what our need is on an annual basis, and we know where that money's coming from for the next, 7 to 10 years, we can go ahead and move forward with the alternatives without concern or with the stocks as well. Same thing with the real estate. So that's how we want to set these up in these different buckets. And we can also take into consideration here a couple of other things. We also still need to have and identify that money for an unexpected, unplanned expense, right? So right now, we're really just talking about our predictable income strategies. We're still going to want to make sure we have a sufficient amount of money set aside for unexpected home maintenance types things, things that, car purchases, those all will get factored in as well. And they'll get factored in the amounts that we're putting either in that short-term bucket, midterm bucket, or potentially the long-term bucket. Okay, let's talk about a little bit about some of these alternative types of investments and why we would want to consider them. And many of you, as I look on the screen here of who's in attendance, we do have, most of you, I believe, do have these because we tend to use them on a regular basis. Real estate funds. The benefit of a real estate fund is simply going to be it gives us the exposure into a sector of the real estate market without actually having to own the brick and mortar ourselves. For some of you, we're using things like self-storage facilities, strategic storage, which is a very niche type of real estate. So there's a couple of things that you have to, make sure you understand when we talk about real estate funds. First of all, they're generally referred to as a REIT, Real Estate Investment Trust. Secondly, you genuinely are investing in real estate. You're just doing so in a pooled investment with others. And by virtue of the fact that you're investing in real estate, it tends to be an illiquid investment. So there are going to be liquidity restrictions on anything that we go to, that we invest in the real estate space. The next thing to take into consideration is that real estate is a very broad term, right? So there's commercial real estate, there's there's residential real estate, there's multifamily real estate, there's industrial real estate, there's self-storage like we talked about. So there's a multitude of types of real estate as well as They can be geographically concentrated. They can be dispersed both domestically and internationally. These are all things that have to be taken into consideration when investing in these types of investments. Things that you want to look at is how do you or how do we feel about the particular sector of the real estate that we're going into? It can be impacted by the economy, it can be impacted obviously by interest rates, right? We need to also understand in a real estate fund, what are we looking to get out of that investment? Is it going to pay us an income? Is it going to just be for long-term growth? So we want to understand what it can bring to the table. But the one benefit of the real estate sector is that it doesn't always correlate to the stock market. And that's one of the big benefits we have with our alternative investments is, quite frankly, that they don't move in lockstep with the market. And because they don't move in lockstep with the market, it lowers our overall correlation of our portfolio. And when we lower our correlation, we are then, in essence, reducing the overall risk in our portfolio while maintaining a higher rate of return. Private equity or hedge funds, this is an opportunity that allows us to invest in companies that are not publicly traded. And again, some of you I know on the list here are also in one of the privately held alternative investments that we use. Benefits to this is that these companies don't experience the same exposure to the market, the trading in the market that we see. So they don't always have that same level of volatility. Access to these are somewhat limited through different types of funds, but nevertheless, this can be a very good way to offset the risk of the stock market. We've not used a lot of commodities here, but they can do the same thing. They can offer an inflation hedge as well. And again, with the portfolio enhancements, alternative investments, we want to consider the higher risk and longer lockup periods, right? So we're only talking about that long-term bucket where we would put these types of investments. So guaranteed income solutions. Guaranteed income solutions, immediate annuities, these are incomes that start now. Deferred annuities, income will begin later. We will typically have been using those more than the immediate annuities. Fixed index annuities, they have growth potential with protection. So in essence, we can go up a portion of how the market goes up, but we are limited to no exposure on the downside. Can help reduce pressure on growth assets in downturns. Again, because we're not exposed to any downturn in the market, this is someplace that we could go to take money if need be, and we're not selling in a down market. Now, what are the downsides and why would we use this type of a guaranteed income solution? First, the downside is if we are investing in an indexed annuity with a guaranteed income rate, we cannot expect that it's going to earn the same rate of return for growth like our long-term investments would do. Just not going to happen. The only reason we would go into these types of investments is to generate the income. So for example, we've got some of these types of investments that will provide a 6.5, or even 7%, depending upon the product, depending upon your age, guaranteed income for life, and that can be for joint life. It also does not require us to annuitize. Annuitizing means changing a lump sum of money for a stream of income. That is not the case here. So for example, let's say that we have $300,000 in an indexed annuity with an income rider. That $300,000, let's further assume, is giving us a 6% guaranteed income stream, $18,000 per year. Fast forward a few years down the road, we're taking income from this, and now all of a sudden we have an emergency and we have to access this amount of money or this particular pot of money. We can do so. Whatever is in that account is still available to us. All right. So we're not annuitizing and giving up our lump sum of money, which is extremely important. The other reason why we like to use the guaranteed income stream, number one, obviously helps us deliver the income we need for our shortfall. But secondly, this then allows us to rely less on fixed income or the bond market, because the bond market has tended to have more volatility over the last decade. And secondly, with interest rates having been very, very low, we just can't create the yield that we need to have inside of the bond market. So we've been using the annuity market, the indexed annuity market, to replace the bond portfolio. Okay. All right. So let's move on here. So again, just example in action, we've got our 1 to 5 year period of time, and we define our time periods, individually with each of you, so that we know we have an idea of what we're looking for and how we're building this portfolio. So an advanced time segmentation portfolio is unique to each of you. Now, while you may have the same investments as many of our other clients, the composition of them, the percentages of them are going to be different. So we may go 1 to 5 years. We've got cash and bonds designed to cover the expenses. We've got income coming in. We've got, again, money readily available if we need to just simply liquidate it. And we know that that's the plan with that money. 6 to 15 years, we're going to use bonds and annuities designed to help provide predictable income, stability of the principal, so that we know if we then need to move some of that money into our shorter term buckets, we have the ability to do that. And then we've got our longer term bucket where we have our stocks and alternatives designed to focus on growth. Again, still can supplement some of the income today if our alternatives are kicking off income, or our stocks are paying dividends. We can use that as part of today's income, but also we have the ability to reinvest those dollars in our longer term bucket to aid in further growth down the road. Again, all of these things are customizable to your individual situation or solution. Okay. So just kind of, in summary here, what we're trying to do is reduce sequence of return risk. So what is sequence of return risk? This is when we are essentially having to sell in a down market. If we have to take income in a down market, it exacerbates the losses, and that just gets the snowball rolling downhill even faster, and we have concerns of potentially running out of money down the road if we are doing this on a regular basis. Can help provide confidence with more predictable income. The reason in large part that I like this concept, and why again we're doing this for the vast majority of you, is that when we have those down years, and as much as we like to try to avoid them, sometimes they are inevitable. The market is going to go down. There's only so much that we can do about that. But one of the things we can do is if we can avoid having to take that money, right, and we have confidence and we know that we've got a few years worth of money not exposed to the market where we can take our income, then we may not like those periods of time, but we have more confidence to know that it's not having a devastating impact on our financial future. And that is ultimately what the goal of advanced time segmentation is. And then allows for longer term growth potential, because that money that we have set aside for long term, we're not selling in a down period. So we know that money can grow for us, either for our future needs or ultimately maybe for the next generation, if that indeed is the case. So do we use this already? Again, for the vast majority of you, absolutely. Our short term is cash reserves, annuities, midterm bonds for income, maybe some blue chip stocks paying dividends, and then our long term are stocks and alternatives for growth. Okay, that's kind of the review of what we're looking for in your portfolio. So for each of you, if you are uncertain of, well, trust me when I tell you we're doing this, but if you're uncertain what that looks like for you, then by all means, let's get together, let's talk about it. If there are parts of this that you feel like, hey, I'm not sure we have that, or I just would like to make sure that we have that, or I was intrigued by this particular thing, by all means, let's get together and go through that. So yeah, so this is the strategy that we think is the key to driving predictable, consistent retirement income that will last you throughout your entire retirement years. But even if we've got everything designed just perfectly for you, obviously we'd love to sit down and go through it with you, make sure you know what we know about your portfolio. With that being said, Max, you want to open it up to some questions? If you've got some questions and you'd like to just put those in the chat, feel free, and we'll take just a minute or two and cover those, and then we'll wrap it up. Get anything there, Max?
No, not yet.
All right, we'll give it another 30 seconds here. I know I rambled on for like 27 minutes, so I figured I probably, hopefully, covered most of your questions with it. All right. Well, we're going to go ahead and wrap this up. I want to thank each of you for joining on. If you've got questions, please reach out to us. Moving forward, if you have folks that you believe would benefit from some of these monthly webinars, please feel free to pass those topics and the webinar invitations along to them. We're more than happy to have any friends or family of yours join us for these webinars. Thanks again so much. Max and I both look forward to talking to you sometime here in the near future. Take care, everybody. Bye-bye.